In 1962, a steel worker in Pittsburgh used 5 financial tools the federal government later made illegal. When he died in 1991, his estate was worth $2.3 million. His own children never knew. Number 12 was banned by Congress in 1986 because it worked too well. Number 4 is now a federal reporting offense over $10,000. And number 1 has built working-class wealth since the Civil War. Yet banks spent decades insisting these tools no longer worked. These 20 were not loopholes. They were kitchen table common sense your grandfather knew. Subscribe because no financial advisor will teach you this. Number 20. The Postal Savings System. Your grandfather walked into the United States Post Office in 1955 and deposited his paycheck into a federal savings account that paid 2% interest, was insured directly by the United States Treasury, and required no relationship with any private bank. The Postal Savings System Act of 1910 created the program specifically to give working-class Americans a safe place to deposit money outside the commercial banking sector. At its peak in 1947, the system held over $4 billion in deposits from more than 4 million American working families. The accounts could not fail. The Treasury backed every penny. But in 1966, Congress voted to abolish the program, and the last accounts closed in 1967. The official reason was administrative cost. The actual reason was that commercial banks had spent 50 years lobbying against a federal competitor that paid better interest and required less paperwork. Today, the Federal Deposit Insurance Corporation insures bank deposits up to $250,000, but only if you trust a private bank to hold them. Your grandfather did not have to. Number 19. The Passbook Savings Account. Your grandmother walked into the local savings and loan with a small leather-bound book, handed it to the teller, and the teller wrote the deposit amount in pen on the next line. There was no monthly statement. There was no online banking. The book itself was the account. From the 1930s through the late 1970s, passbook savings accounts paid between 3 and 5% interest by federal law under Regulation Q. Every working-class family had one. It was the most boring, most reliable savings vehicle in American banking. By 1965, over 37 million Americans held passbook accounts collectively containing more than $150 billion in personal savings. But in 1986, the Federal Reserve eliminated Regulation Q and deregulated savings account interest rates entirely. Within 5 years, banks dropped passbook rates to less than 1%. Today, the average American savings account pays approximately 0.5% interest, and the leather book has been replaced by a banking app that quietly tracks your spending habits. Your grandmother could read her own balance without an internet connection. You actually cannot. Number 18. Savings Stamps and the Series E War Bond. Your grandfather bought a 25-cent savings stamp at the post office every Friday, pasted it into a small booklet, and when the booklet was full, traded it for a $25 Series E War Bond. The bond matured in 10 years and paid out $33.75. It was a guaranteed 50% return backed by the United States government. Between 1941 and 1980, the Treasury issued more than $185 billion in Series E bonds to ordinary American households. School children ran stamp drives. Factory workers bought bonds through payroll deduction. Banks were not involved at all. The system taught 2 generations of Americans that small, consistent deposits compound into real wealth. The Treasury discontinued Series E bonds in 1980 and replaced them with EE bonds at lower yields. By 2012, the rate had dropped to 0.1%, and the paper bond itself was discontinued entirely. Today, the Treasury offers I-bonds online, but the system that taught children to save is gone. Your grandfather started with 25 cents. He retired with a paid-off house. Number 17, the United States Silver Certificate. Your grandfather kept a small stack of paper currency in his desk drawer that was not Federal Reserve notes. It was United States Silver Certificates, issued by the Treasury from 1878 through 1964, and every certificate could be redeemed for the equivalent value in physical silver from any Treasury office or Federal Reserve Bank. A $1 silver certificate was a literal claim check on actual silver in a Treasury vault. Your grandfather could walk into a federal facility and exchange paper for metal. By 1963, over $400 million in silver certificates were in circulation. But in March 1964, Treasury Secretary C. Douglas Dillon announced the certificates would no longer be redeemable for silver. By June 1968, the redemption window closed entirely. The Coinage Act of 1965 had already removed silver from American dimes and quarters. The link between the dollar and physical silver was severed in less than 4 years. Today, a $1 silver certificate from 1957 is worth approximately $1 as paper currency and approximately $25 in silver content. Your grandfather knew the real difference. Number 16, the United States note. Your grandfather carried 2 kinds of paper currency in his wallet, and only one of them was issued by the Federal Reserve. The other was a United States note, printed directly by the Treasury with a red seal and red serial numbers. Federal Reserve notes carried a green seal. United States notes were a form of debt-free currency, authorized by Congress in 1862 and issued continuously for over 100 years. They were not borrowed from any central bank. They were not based on any interest-bearing federal debt. They were simply money the government printed without owing interest to anyone. Between 1862 and 1971, the Treasury circulated billions of dollars in United States notes alongside Federal Reserve notes. Most Americans never noticed the difference. Both spent the same. But on January 21, 1971, the Treasury quietly stopped issuing the red seal currency, citing redundancy. By 1996, the remaining notes were withdrawn from circulation. Today, every dollar in your wallet is a Federal Reserve note, which is a debt instrument by definition. Your grandfather held both. You hold only the one. Number 15, physical gold coin ownership. Your grandfather kept a small collection of $20 St. Gaudens gold coins in a coffee tin buried behind the woodshed. Every American adult could legally own physical gold coins as currency until April 5, 1933. On that day, President Franklin Roosevelt signed Executive Order 6102, criminalizing the private ownership of gold coins, gold bullion, and gold certificates within the continental United States. Citizens were required to surrender their gold to the Federal Reserve at $20.67 per ounce. Refusal carried a fine of $10,000 and up to 10 years in prison. Within 8 months, the official gold price was raised to $35 per ounce, instantly devaluing the dollar by nearly 70%. Americans who had complied lost 40 cents on every dollar of gold they had surrendered. The ban on private gold ownership lasted 41 years. It was repealed on December 31, 1974, under President Ford. Today, physical gold is legal again, but most Americans hold none. Your grandfather held it before it was illegal. He held it again the day it was legal. He never sold. Number 14, gold clauses in private contracts. Your grandfather signed a mortgage in 1925 that required repayment in gold dollars of a specific weight and purity. Banks, businesses, and ordinary citizens used these gold clauses throughout the late 1800s and early 1900s as protection against currency devaluation. If the federal government inflated the dollar, the contract still required payment in gold equivalent value. It was a private hedge against public mismanagement of the money supply. But the Joint Resolution of June 5, 1933, declared all existing gold clauses unenforceable. Congress voided millions of private contracts in a single day. The Supreme Court upheld the resolution in 1935 by a 5-4 vote in the Gold Clause cases. Americans who had specifically protected themselves against inflation lost that protection by federal decree. Gold clauses remained illegal until October 28, 1977, when Congress restored the right to enforce them in new contracts under Public Law 95-147. Most Americans have never heard of them. Banks do not advertise that contracts can still include them. Your grandfather understood why they existed. You probably do not. Number 13, the anonymous money order. Your grandfather walked into the post office in 1962, paid cash, and bought a $200 postal money order made out to anyone he chose. There was no identification requirement, there was no reporting form, there was no record beyond the serial number on the order itself. Postal money orders were a working-class wire transfer system that operated without any federal tracking from their creation in 1864 through the early 1970s. By 1965, the United States Postal Service was issuing over 270 million money orders per year. Working families used them for rent payments, family transfers, and small business transactions. The system required no bank account and no permanent paper trail. But the Bank Secrecy Act of 1970 required money orders over $1,000 to be logged with full purchaser identification. By 1986, the threshold was lowered to $3,000. Today, any postal money order over $3,000 generates a monetary instrument log report sent directly to the Treasury Department. Your grandfather sent money without paperwork. You cannot. Number 12. The second mortgage interest deduction. Your grandfather used a second mortgage on his paid-off home to start a small contracting business in 1978. The interest on that loan was fully tax-deductible, regardless of how the money was spent. The Internal Revenue Code allowed homeowners to deduct interest on any second mortgage, home equity loan, or refinance. No questions asked. By 1985, over 15 million American households used home equity loans this way, treating their houses as a low-cost source of business capital, education funding, or emergency liquidity. Then, the Tax Reform Act of 1986 changed everything. President Reagan signed the bill on October 22, 1986. The new law eliminated the personal interest deduction on most consumer loans and restricted home equity interest deductions to mortgages used solely for home improvement. Borrowing against your own paid-off house to start a business no longer carried any tax advantage. Bank lobbyists had wanted the change for years. Your grandfather had used his house as a private bank. Congress made the house just a house. Number 11. The bearer bond. Your grandfather held a $1,000 corporate bearer bond in a safe deposit box in 1969. Whoever physically held the certificate owned the bond. There were no names on it. There was no registration. Coupons attached to the bond could be clipped and cashed at any bank anywhere in the United States by anyone holding the paper. From the 1800s through the early 1980s, bearer bonds were a standard part of American capital markets. Corporations issued them. Working-class families bought them. They were a private wealth vehicle that traded outside any registry system. But the Tax Equity and Fiscal Responsibility Act of 1982 effectively ended the issuance of new bearer bonds by stripping the tax exemption from interest payments on unregistered municipal bonds. Within 3 years, every major American corporation stopped issuing them. The remaining bonds matured and disappeared. Today, bearer bonds exist only in spy movies. Your grandfather held actual ones. The tool was not banned outright. It was simply made impossible to use legally. Number 10. The home cottage industry. Your grandmother ran a small mail-order seed business from her kitchen table in 1958 and sold $3,000 worth of merchandise per year without filing a single federal form. The threshold for self-employment income reporting was set at $400 annually, but enforcement of cottage industries operating on cash and personal check was virtually non-existent. The Internal Revenue Service did not have the infrastructure to track home-based microbusinesses. By 1965, an estimated 4 million American families ran some form of home-based income operation. Egg routes, quilt sales, mail order catalogs run from kitchen tables. Children licked stamps. Mothers wrapped packages. Fathers drove orders to the post office on Saturdays. The income stayed in the household. But the Tax Reform Act of 1986 required third-party payment platforms and merchant processors to report income above $20,000 to the IRS. The American Rescue Plan Act of 2021 lowered that threshold to $600 per year through Form 1099-K. Today, your grandmother's seed business would generate 15 separate federal forms. She just ran it. Number 9. The sub-$10,000 cash transaction. Your grandfather walked into the local Cadillac dealership in 1967, counted out $4,800 in $20 bills, and drove home in a brand new Coupe de Ville. The dealer counted the cash, signed the title, and shook his hand. There was no reporting requirement. There was no federal form. There was no paper trail beyond the title transfer at the county clerk's office. Cash transactions of any size were legal, normal, and entirely private from the federal government. Working-class Americans routinely paid cash for cars, appliances, down payments on homes, and major medical procedures. The cash itself was proof of purchase. The transaction belonged to the buyer and the seller alone. But the Bank Secrecy Act of 1970 introduced the Currency Transaction Report, requiring any financial institution to report cash transactions over $10,000 to the Treasury. Today, the IRS processes over 20 million currency transaction reports every single year. Structuring transactions to stay below the threshold is itself a federal crime. Your grandfather paid cash. You cannot. Number 8. The postal money order without identification. Your grandfather purchased a $99 postal money order in 1969 with no identification, no signature, and no name on file. He mailed it to a cousin in Oklahoma to help pay for a tractor repair. The Postal Service processed over 260 million money orders that year. None of them required photo identification. None of them generated a federal report. The system was deliberately designed for working-class Americans who did not have bank accounts. By 1972, the Bank Secrecy Act implementing regulations required identification for postal money orders over $3,000. By 2003, the threshold was lowered to $1,000. Today, any postal money order purchased with cash over $3,000 requires photo identification, full address, social security number, and a monetary instrument log entry that is retained by the Postal Service for 5 years and accessible to federal investigators. The same anonymous payment tool that working families used for over a century now generates a federal compliance form. Your grandfather mailed money. You file paperwork. Number 7, the dividend reinvestment plan and the working class millionaire. In 1959, a janitor named Ronald Read started buying single shares of common stock through dividend reinvestment plans offered directly by American corporations. He bought shares of AT&T, Procter & Gamble, General Electric, and J.M. Smucker through drips that required no broker, no minimum balance, and no fees. Every quarter, his dividends purchased fractional shares automatically. He never sold, he never traded, he never read a stock chart. When Ronald Read died in 2014 in Brattleboro, Vermont, at the age of 92, his executor counted $8 million in his estate. The town was stunned. The man had worn flannel shirts, driven a used Toyota, and cut his own firewood for 60 years. The DRIP program was created by AT&T in 1969 and adopted by hundreds of major American corporations. It was the working-class path to ownership of American capitalism. But the SEC tightened transfer agent rules in the 2000s, and most companies have since outsourced DRIP administration to third-party platforms with fees, minimums, and account thresholds. The original tool still exists technically. Few companies still offer it directly. Number 6, the personal check float. Your grandfather wrote a check at the hardware store on a Tuesday, knowing the check would not clear his bank until Friday. The 3-day clearing window was real money. He used those 3 days to move funds, deposit his paycheck, or pay another bill. Banks called it kiting if you wrote checks beyond your balance. Everyone else called it Tuesday. But the Federal Reserve's Check 21 Act of 2003 eliminated paper check float entirely. Today, an overdraft from a single bounce check costs the average American $34 in fees, and the banking industry earns over $11 billion annually from overdraft charges alone. Your grandfather managed cash flow with paper. You manage it with permission. Number 5, the private lending circle. Your grandmother participated in a neighborhood lending circle in 1962 with 11 other women, each contributing $20 a month into a rotating pool. Every month, one member received the full $240, used it for emergencies, home repairs, or down payments, and the cycle continued for 12 months. No interest, no bank, no paperwork. These pooled savings circles operated openly through the 1970s, but the Securities and Exchange Commission classified pooled investment arrangements above certain thresholds as investment contracts under the Howey test of 1946. Modern enforcement requires participants to be accredited investors with $200,000 income or $1 million net worth. Your grandmother needed $20 and a handshake. You need a securities lawyer. Number 4, the cash purchase over $10,000. Your grandfather walked into a car dealership in 1971 with $11,500 in $100 bills and bought a Cadillac Eldorado outright. The dealer signed the title, handed him the keys, and the transaction ended there. There was no federal form. But the Bank Secrecy Act of 1970 and the Tax Reform Act of 1984 created Form 8300, requiring any business that accepts more than $10,000 in cash to file a report with the IRS. The threshold has never been adjusted for inflation. Today, paying cash for a $12,000 car triggers an automatic federal reporting form sent to the IRS within 15 days. Your grandfather paid cash for a car. You file Form 8300. Number 3, the whole life insurance policy loan. Your grandfather took out a $5,000 whole life insurance policy on himself in 1948 and paid $4 a month for 30 years. By 1978, the policy had accumulated $7,400 in cash value, and he could borrow against it at a fixed 5% rate regardless of what banks were charging. The money was tax-free. Working-class families used these policies as private banking systems for over a century, borrowing for business startups, home down payments, and emergencies without ever speaking to a banker. But the Tax Reform Act of 1986 limited the deductibility of policy loan interest. The Technical and Miscellaneous Revenue Act of 1988 further restricted modified endowment contracts. Today, whole life is dismissed by financial advisors as a bad investment. Your grandfather did not invest in it, he banked in it. Number 2, the Tax Lien Certificate Auction. Your grandfather attended the county courthouse auction every spring in 1968 and bought tax lien certificates on delinquent properties for pennies on the dollar. Your grandfather paid the back taxes, received a certificate, and earned 12 to 18% interest until the original owner redeemed it. If the owner never redeemed, your grandfather acquired the property. The system operated openly in every state from the 1800s through the 1990s. Working-class investors built rental portfolios by attending these auctions consistently for 20 years. But large institutional investors and hedge funds now dominate the bidding. By 2010, firms like JP Morgan and Bank of America purchased $1 billion in tax liens annually. Your grandfather knew the county clerk's auction schedule the way other men knew the baseball schedule. Most Americans today have never heard of it. Number 1, physical cash itself. This is the one that ties everything together. Every tool on this list depended on physical cash as a bearer instrument. Silver certificates, bearer bonds, postal money orders, tax lien auctions, policy loans, lending circles. Each assumed an American could hold paper currency and complete a transaction without permission. It was not a tool. It was a worldview. American working-class wealth before 1986 assumed every family could accumulate gold, silver, paper currency, property, and credit outside the federal banking system. The entire system was built around that assumption. Cash was anonymous. Cash was final. Cash required no permission from anyone, anywhere. Today, the Federal Reserve has begun pilot testing a central bank digital currency, and major financial institutions openly project a cashless economy within 20 years. Your grandfather held physical money. The right to hold it is now under quiet review.